Welcome back to the Teaching Tax Flow podcast, everybody. Today, episode 165, we are going to look at HSAs. So if you don't know what that is, we will give you the definition of what an HSA is. If you don't know, but you will very shortly after this brief moment from our episode sponsor.
This podcast is brought to you by Legacy Lock. If you are new to estate planning or simply need to review your current plan, Legacy Lock makes it as easy as pie. Legacy Lock is a unique platform that enables you to easily complete your attorney-drafted documents conveniently from the comfort of your home or office. Your first step to this peace of mind is simply visiting teachingtaxflow.com/legacy.
We are going to talk about HSAs today. So what those are, obviously, health savings accounts. So there's a lot of detail around these, but actually, I would say in some sense, they're simpler than you may actually think if you're working with the best people around you, or as we like to say, your personal board of directors. So Chris Picciurro, welcome back to your own show, sir. We're going to talk about this today or what?
Yep, let's get rolling into it. And as you know, I reside in the tristar state, the state of Tennessee. So the health savings account, we call it the tristar tax advantaged investment. And there are three main tax benefits to a HSA, but let's talk about what it is first. Because remember, with teaching tax flow, one of our laws is that tax agencies are your involuntary business partner. Tax laws are written to encourage or discourage certain behavior. So the laws are written to encourage us to put money away for our medical needs. And there's definitely some tax advantages to starting an HSA account. We're going to talk a little bit about qualifications, but that's something you're going to want to lean into your medical insurance provider to discuss to see if you are eligible for an HSA. We'll talk about it at a 30,000 foot view limit. And ultimately, understand this, that medical expenses paid out of pocket are only deductible if, one, you itemize your deductions, which the vast majority of taxpayers actually do not itemize their deductions. And two, even if you itemize your deductions, the medical expenses exceed 7.5% of your income. So let's say your income's $100,000. Even if you itemize your deductions, only the medical expenses that exceed 75% or $7,500 are deductible. Well, if you could put money into an HSA and use that for the medical expenses, ultimately you are getting those pre-tax. So yeah, so an HSA stands for a health savings account, and it's a special savings account. You can have that with a credit union, a bank. You could actually invest in stocks and mutual funds and such with your HSA. Obviously, talk to your licensed financial advisor, but it's a special savings account that you use just for your healthcare costs. So like going to the doctor, buying medicine, getting glasses, and it's a pretty big benefit to you. And I would say one of the mistakes I made when I was younger was that younger people are usually in their 20s, they don't have a lot of medical expenses, so they don't think that an HSA is important. Well, if anything, that's when it is important to put money away so that it can grow, and you could use it later in life for your medical expenses, your spouse's medical expenses, or a dependent's medical expense. So
Yeah, I like how you said when you were younger, right? Because and speaking for somebody that's, in reality, I'm not a whole lot younger than you, sir. I know we poke fun at each other for that. But, when we look at these, and I don't know at what age, but just in the name, right? People are like, oh, it's a savings account. I'm going to save for something. But as you mentioned, and why we're talking about it here, right? There are very, very positive tax implications from doing this, right?
Yeah.
So kind of not delineating differentiating what it is and what it's not based on that. But there's a lot to it that goes beyond just having the money for something in the future, right?
Yes. So let's talk about that triple threat or that tristar tax benefit. And the first thing is this: the money you put into a health savings account, or what's called your contribution, is a tax deduction, or it's going in pre-tax through your employment. So like my wife, for instance, works at a school. They have a health savings account. So we maximize the amount we're putting in our health savings account, and that's going through her salary. Well, that money is going in pre-tax. So when we get her W-2 at the end of the year, that does not reflect as taxable income. Conversely, you could, let's say you're self-employed or what have you, you could make contributions to an HSA outside of your W-2 wages if you're eligible, and then just take a deduction on your personal tax return. So ultimately, the money is going in what we call pre-tax, meaning you're getting a tax deduction for the contributed funds into the HSA. Now the money is in an HSA. It grows tax-free. So the HSA is similar to a traditional IRA in so fact that you're getting a deduction when you contribute the money. It's similar to a Roth IRA when when the money grows tax-free, right? And then it's similar to a 529 plan that if you take a distribution that is used for qualified expenses, the distribution's tax-free. So ultimately, the HSA is a Frankenstein of traditional IRA, Roth IRA, and a 529 plan.
And talk about
They
free
have all
money.
three of those benefits. Yeah, so that money grows tax-free. And then when you use it for qualified medical expenses, then the distributions are tax-free. Here's the nice thing about an HSA that's a little different than an FSA, what's called a flex spending account. An FSA is typically set up through an employer and you have a use it or lose it situation. An HSA, if I contribute $5,000 into an HSA this year, I might not even have $5,000 of medical expenses in 2025 or 26. That's okay. The money can roll forward. It's a savings account for you
Mhm.
for the future. So that's that triple threat tax benefit that we
Yeah.
really like on the health savings account.
And the difference, I'm glad you said that too, an FSA. And Chris, you'll laugh at this, us being both from Michigan. You know what almost I spit out of my mouth is that's why there's a run at Block Drugs at the end of the year. But you remember Block Drugs? They've been out of business probably for 25, 30 years. It's a drugstore in Michigan. But the Flex plan, that's where the Flex account, that's probably what people are like, "Oh boy, it's December 28th. I got to go spend this somewhere on,
Sure.
Band-Aids." I don't know. I'm just making it up. But the HSA, and there's a lot more to it. But again, I love that we're tying this in to tax, right? Because it's just not an account for use. It's like you mentioned with your wife. What a great example, right? Like literally tax-free, growing tax-free, distribution tax-free.
Exactly. In the FSA, that's why you'll see a lot of people getting in with their dentist at the end of the year. It's hard to get in for a dental cleaning or a procedure because they've got money
Mm,
that they have to use. An HSA is different. But you
right.
can use an HSA for dental expenses. So who can contribute? Who can have an HSA? Well, it's someone that has what's called a HDHP. Oh gosh, that's a high deductible health plan. So again, that's where you're going to want to talk to your health insurance provider or if you work with someone on picking health insurance or your HR department, determine if you have an HSA eligible plan. They're going to be able to answer it just like that. So, assuming you have an HDHP or a high deductible health insurance plan, that means you are eligible for an HSA. You cannot be enrolled in Medicare though. So, and you cannot be a dependent on someone else's return. So, those are some of the eligibility requirements, but many people uh, can have an HSA. And here's the other thing, John. Let's say you were eligible for an HSA for 10 years. Let's say you worked somewhere and then you go out on your own and you get a health insurance plan that's not a high deductible plan. That's okay. That HSA is still yours to use, and you can still use that for any health expenses. You don't have to stay eligible over and over and over again.
Interesting.
You're,
Okay.
yeah, so it's a really nice benefit.
Yeah.
2025 limits, and these are always these are typically going to be indexed for inflation, but just give us an idea. For individuals, it's about $4,300. A family is about $8,500, and then if someone's 55 and older, there's what's called a catch up. I call it the Heinz 57 contribution or catch up contribution. So a family where someone's 55 and older could put up to or over $9,500 a year into the HSA, and check with your employer too. Many employers contribute on your behalf, even if you don't contribute. So that's
Hmm.
pretty cool. So
Interesting.
it
So yeah, it
definitely
seems like there's a lot that goes into. Actually, I shouldn't say there's a lot, that there's more that goes into selecting the plan or figuring out if you're qualified, but the right person is the person that you probably talk to anyways about your health insurance, right? So it's not like you have to go out and find somebody else just to do this. Like it's an easy thing to do. But then here's a question for you on this, very related. Obviously there's huge, we'll say substantial tax benefits to doing this. Is that usually something that's even really brought up when somebody's discussing this with a insurance, not a broker, but the person helping to select that? Or is that something that they need to then make sure that their tax preparer knows? that this is going.
But
Of
I'm
like,
sorry, buddy. I don't
no, no, you're
understand that
good. You're good.
question.
You're good. It was kind of a lot in there. Like, is this something like, say I have somebody that I go through, I talk to, say my employer, a
Mhm.
private broker for health insurance.
Sure.
I go to them, ask these questions. If I qualify, they give the thumbs up. They say, yep, you're good. Get one. I go through them
Sure.
to get one. What do I have to do? What comes back in my court to make sure that I'm taking advantage of the tax benefits? Is it something
Well,
I have to
usually if
then
you're wait,
provide, right?
if it's your employer, then it just goes through your W-2, just like my wife's situation.
Right. But say you're
If not,
self-employed.
then if you're self-employed, then you'd have to go to a bank, credit union, and set up or a financial institution and set up an HSA account, and then you can contribute to it out of your pocket, and then you get a deduction for it.
Perfect, perfect. Nope,
Yep.
that explains it. So it does come a little bit back into the taxpayer's court if you're self-employed versus if it's, on a
Well, yeah,
W-2,
I
it's
mean,
all there.
ultimately, you're always responsible for your own finances, even when you're working with other people. You still have to enroll, and you still have to make that election to contribute to the HSA. It's not an automatic. Just because you're eligible, it doesn't mean it's an automatic contribution.
Perfect.
So,
Nothing is automatic, right? At all.
well, at this point, there's some rule changes with retirement plans down the road with Secure 2.0 Act, where people are going to be automatically enrolled. But as far as this, no, nothing's automatic. The one thing a good tax planners do is they say, all right, let's say my deductible is, I'm just making up a number, is $5,000. My maximum out of pocket is $3,000. Um, you might as well take, so your exposure each year with the health insurance coverage you have is 8,000. If you're a family that gets, if you have a large family like ours and someone's going to be sick, someone's going to get hurt, someone's going to break something, something's going to happen, someone's going to need braces, eyeglasses. My wife and I just say, well, instead of paying that and getting no deduction for it, let's just sock everything the max we can into the HSA and then use that. Now, obviously, if your medical expenses exceed the health savings account, then you've got to go out of pocket for those. But that's why it's important to, if you can afford it, max your HSA, even if you don't need to use all those dollars in the year you funded it. Because remember, it's going to grow tax free as long as an eligible distribution is made. Now, as we wrap up, let's talk about what you can spend your HSA dollars on. Because there's a lot, there are a lot of things you can, I'll give you an example or my wife and I, she, we, unfortunately, I sustained a pretty serious injury to my leg, playing, of course, pickleball. And, we needed, there's a, like a machine that can help me recover quicker. And it was like a couple $100, but we used it was HSA eligible. 99% of the time when you look at buying a medical device or something like that, physical therapy related, you're going to, it'll let you know if it's HSA eligible. And like for ours, and many HSAs give you a debit card to utilize. So let's say you go grocery shopping, you stop and get, something that's HSA eligible. Typically, when you check out, the checkout's going to identify what is eligible for HSA, and you can use that HSA debit card for those expenses. And then obviously your personal expenses can be, now these are at larger grocery stores, like as you like to say, Wally World, and some of the other places.
In reference to Walmart. So yeah,
Yes.
there's obviously some very defined things that can be used on. Something I didn't see on that list though, I visited you right after you hurt yourself. I wonder if I could
Mhm.
send you an invoice for like your emotional support friend. Because when Chris
Yep.
can't play pickleball, by the way, it is a very disturbing situation for
The
everybody around him.
disturbing.
So
Yes. Luckily, after being out almost 2 months, I'm back in action. So okay, what's qualified? Doctor and medical services. So that's going to be office business, lab tests, surgeries, physical therapy, chiropractic care, medicine and drugs. So prescription medicines, but also over the counter drugs. Excuse me, like ibuprofen and allergy medicine. Insulin is usable for HSA. Dental care. So for us, I mean, we got 5 mouths with a bunch of teeth in them. So our cleanings and any type of extra. I mean, I had to get a couple teeth extra. Not a fun experience a couple years ago, but a couple teeth extracted. That wasn't fun, and it had insult to injury. It stinks paying for it. So at least well, actually after the extraction, so my wife had to drive me home because I was coming out of anesthesia. Uh, we slapped our HSA card on the counter. But vision care, luckily I have never had to you wear glasses. The one that wears glasses is my wife, and if you saw me, you'd realize why. But eye exams, glasses, contact lenses, LASIK, eye surgery could be used. So think about, these are some big expenses. Hospital emergency services like hospital stays, ambulance. You want to avoid an ambulance ride, but anesthesia, pregnancy and family planning, fertility treatments, and those sort of things. So again, these are things that you might, when you're early 20s, you might not be thinking you need, but it's kind of, and the nice thing about the HSA, especially if you're with an employer, it's kind of like set it and forget it. It comes out of your W-2 wages and you kind of forget about it. And then that money's there when you need it. So no, in my case, medical equipment and aids. So medical aids like crutcher. At least I didn't need crutches, but crutches, walkers, and canes. I don't need a cane yet. Wheelchairs, hearing aids, those for people with sleep apnea. John, you might be going down that route since you threw me under the bus. CPAP
Yeah.
machine.
Oh yeah. I snore like a saw.
And then in all seriousness, like mental health and therapy. So counseling and psychiatry. So again, a lot of expenses that you are eligible. So the bottom line is at some point, you're going to have medical expenses in your life. At least be smart and make them tax deductible. And if you can, fund that HSA. And then at the end of the year, if you contribute to an HSA or you take distributions from an HSA, there'll be some tax reporting to do. There's a special tax form called the Form 8889. Your tax preparer will be very aware of. But yeah, these are really good opportunities that you should be thinking about early. And so get at it, guys. Come on.
And you hit so many good points here too. And I'll close on this, right? Is the earlier you start something like this, it doesn't have to be, I'm going to max it out when I'm 20 years old and continue to max it out, right? I think you mentioned that keyword. If you can afford it, max it out as much as you can. It's not a use it or lose it every year. It's going to grow tax-free. Again, distributions tax-free. And it's almost inevitable that at some point you're going to have some pretty substantial medical expenses. So you might as well take advantage of it all as you can, start smaller, grow into it, maybe whatever it is. I wish I knew about this 20 years ago. But again, the tax benefits, in my opinion, almost outweigh what the actual input of dollars go into it in some sense too, if depending on your situation. So this really, again, is not as complicated, I think, as some people think it is. It's pretty straightforward. Again, just, obviously taking the responsibility of reporting that, I've set it up, I'm utilizing it, I'm funding it, etc. And yeah, check all the boxes. Right. So, Chris, is there anything else we might want to add to this?
Consider as if you're listening to this, there is an option to do a once in a lifetime rollover from an IRA, which if you take money out of the IRA, it's going to be taxable, to an HSA. It's called a qualified HSA funding distribution, or a QHFD. Again, this is not something you should just go do willy-nilly on your own, but that's something to consider. And then in some cases, you can actually roll a 529 plan over to an HSA. So again, talk to your tax professional, talk to your financial advisor. But if these are alternative ways to funding your HSA. And yeah, so let's action item here as we wrap up the end of 2025. If you're eligible for an HSA, make sure you're maxing that out if you could afford it. And if not, hopefully get started in 2026. And definitely, if you like what you're hearing and you appreciate the information that we're giving out, just subscribe to this wonderful YouTube channel if you're watching. Again, apologize for our appearance. Wish we were more handsome. But if you're listening, thank you. Rate, review, and subscribe on all the podcast outlets.
Absolutely. Great way to end it here, Chris. And again, thank you everybody for joining us here on the Teaching Tax Flow podcast. Glad you could join us and kind of watch how we marry two things together, right? Taking something that you may think has no tax benefit and showing just exactly how powerful that is. So have a great week, everybody. We'll see you back here again next week on the podcast. Same day of the week, different date, completely different topic.
The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum.